Hello everyone, and once again welcome back to another video. As you can see from the title, today's video is about dividend investing for passive income. So two things to address here. First of all, the concept of dividends and the concept of passive income. So let's start with dividends first. Okay, so first of all, what is a dividend? A dividend is a sum of money that companies pay out to someone who owns shares within the company. So that person, he or she, then becomes the shareholder within that company. Now, what is a dividend investing? So essentially it is investing in the stock market in companies that pay out their profits or part of their profits to their shareholders in the form of dividends that we've just discussed. So if this doesn't make much sense just yet, think of it as a way for companies to show its gratitude and appreciation to you or the investor for having trusted their business and having invested some money into it. So companies such as Facebook, Apple, McDonald's will pay you to be a shareholder of theirs. Now, when we think about the concept of investing, very generally speaking, there are mainly two schools of thought. So there are the growth investors and the dividend investors. Growth investors are in there to purchase shares in order to hope that in the future the price of the underlying asset will go up. So say that someone invests in Apple at $200 a share, they buy 10 shares, so they've invested $2,000. All they are waiting for is that capital appreciation over time. So they are hoping that that $2,000 turns into $2,500, $3,000, $5,000 over a 3, 5, 10-year period. Whereas dividend investors, which is today's main focus, they are in there just to collect that paycheck. They only invest in companies that only pay dividends, either on a monthly, quarterly, or yearly basis. So they're in there just for that constant cash flow. Well, if you wanted to invest in a company, however, you would need to have a brokerage account, first of all, which is essentially a bank account where you can hold your investments and deal through it directly. So if you wanted to invest in some of your favorite companies and be paid from them, you will actually need to open an investment account first. That is very easily done, and in a country like the UK, but mainland Europe, as well as the USA, that's really sort of common for lots of brokers to offer you very good commissions and opportunities to open an account for them. So commissions is one of them, like I've mentioned, a very important topic when it comes to investing, because people like me, like beginners with a very low capital, very low initial investment, they will then struggle to accept the fact that if they invest £100, then 10% of that has already gone on costs, and therefore it's really key to find the best opportunity to save on those commissions. So first of all, costs that I've covered, they are now in the UK there are opportunities for you to actually save 100% of those costs with zero fee investing. So I've taken a screenshot of one of the brokers that I use to invest. That will be Free Trade, but I believe other companies such as Trading 212, Revolut, eToro, and so forth, they also offer a similar service. But Free Trade is the one that I use, very simple to use, and that's what I'm sticking with at the moment. So at this point in time, I know that if I want to invest £100, that full £100 is going into it. There's also other things to consider, such as stamp duty, so the 0.5% if you buy shares that are traded on the main exchange and not the alternative investment market, but that's a whole new concept, and that's not today's focus. Now, let's say that you have chosen your broker, you've opened an account, and you're ready to invest. You've done your research and found a couple of companies that you would like to invest in. So how do you know what to do in order to receive the dividend? Well, this is explained by the ex-dividend date. So the ex-dividend date is very important because it determines whether the buyer of a stock will be actually entitled to receive the upcoming dividend. So to receive the upcoming dividend, shareholders must have bought the stock before the ex-dividend date. And also very important to note, on the ex-dividend date, stock prices typically decline by the amount of the dividend. So it's totally natural and physiological. Don't worry if that you see that happening. So I found a very interesting and useful website a couple of months ago, and I've been using it ever since to make my investment decisions. and it's just called dividenddata.co.uk. So all this website does is it breaks down by the major indices. So the FTSE 100, FTSE 250, that's alternative investment market. That's what I just referred to earlier, but let's not focus too much on these other markets, and let's stick to the most famous and liquid ones. So the FTSE 100, for example, is the main basket of the biggest 100 companies in the UK by market cap or market capitalization. And let's say that you've done your research in one of the biggest banks in the UK, RBS or Royal Bank of Scotland, and you want to invest in it because you know that the dividend yield is very high. So anything between a 3% and a 5% is considered to be very high. So this is a 6% yield, which is obviously very attractive. Now, very important thing to consider, because the dividend yield is the percentage of the dividend that you will receive based off of the share price at that point in time, so in this case would be the 13th of March. Obviously, for the laws of mathematics, if that increases, that will decrease. They are linked by an inverted correlation. So we all know what's happened in the market over the past couple of weeks. Royal Bank of Scotland had most definitely taken a hit, and therefore that would then result in a higher than average yield. But let's say that you really like Royal Bank of Scotland. Well, this says declaration day 14th of Feb. So the company has officially announced that they will be paying a dividend to the shareholders. That happened on the 14th of February. In order to receive the dividend, which will be paid, so payment date on the 4th of May, you must have purchased the stock by or before the 26th of March. So you need to know that in order to get that 8p for each share you own, you need to have bought the shares before on the 26th of March. So that's all it's about. This website is really good because all it says is this is the list of the major companies. This is how much they yield. This is when you need to buy it, and this is where when you receive the dividend. You can do the same for the FTSE 250 and so forth. So it's very, very easy, which is why I've stuck with it for the major part of the past 4 to 5 months, because as you know, it's very self-explanatory and easy to use. So that would be it for the dividend part of it. Now let's move on to the other half of this video, which would be the concept of passive income. So how do they link together? First of all, what is it? So passive income is income that requires little to no effort to earn and maintain. So examples of passive income could include the rental income or any business activities in which the earner does not materially participate. So what I mean by that, when you think of someone who purchases a property to rent it out, after they've done all the paperwork, after they've sorted the mortgage, after they spoke to conveyancers and surveyors to arrange the purchase of the house, and after they find the person who will actually live in their property and pay them a rent, do they actually need to do anything, as in physically and actively, in order to receive that paycheck at the end of the month? Well, absolutely not, unless anything goes wrong, something breaks down in the property, which is quite common, unfortunately. But as a rule of thought, after you've put in the work up front, there is nothing you need to do thereafter, which is why it's called passive income, because it's not active. Well, why is it so important? So I've condensed my research into 5 main bullet points. So first of all, passive income gives you the freedom of time. So we all know that time is the most precious of commodities. We just get 24 hours in a day, and that's all we get. Not one person on this earth has more than that. So it doesn't matter their age, occupation, religion, where they live, none of this. Time is the greatest equalizer, I'd like to think of it as, because not a single person can have more of it. We're all equal under that sort of metric. So it can never be recreated or respent. So it exists once, and it just is gone thereafter. So it's precisely why passive income is so important, because time is way more valuable than money is. Then it reduces your stress, anxiety, and fear of failure. So there's nothing worse than having the pressure that comes along with the inability to pay your bills. It causes anxiety, fear, and the overall hopeless desperation for the future. You never know what's going to happen, and you constantly have to worry about it. So passive income tackles this issue and solves it over time. Third point would be that it allows you to pursue doing the things you love rather than what pays the bills. This is very important because we only get one life and we have to live to the fullest. So we all have things that we are passionate about doing in life, whether it's reading books, whether it's traveling, whether it's growing plants and going to other countries to discover their cultures and eat different foods. Whatever this might be, it allows you to exit that rat race that we see from the book that this man has written, Robert Kiyosaki, which is the book called Rich Dad Poor Dad, and this is where the quote for this video came from as well. Then, passive income gives you the ability to live and work from anywhere. So, I don't know about you, but I really love traveling. I enjoy moving country and sort of experiences new cultures like I've previously mentioned. So if I were to be able to find a way for me to then travel and keep doing what I like doing without having to worry about having to be in one physical place for the rest of my life in order to pay the bills, then I'd welcome that very highly. Then finally, it provides a platform for financial stability and growth. So exactly that. When your income is pretty much automatic, you don't need to worry about meeting your expenses at the end of the month, by exchanging time for money. And that's the key message I'm trying to share here. So if it's so simple, then why isn't everyone doing it? Well, first of all, I'd like to say that the main reason for this, in my opinion, is the lack of education. People simply may not know about this. They may not even know it's an option. They don't know it's out there. They don't know it exists. They don't think it's part of the 2020 reality we live in. But actually, if you think about the fact that many people will see passive income as something that you do once and then it's done for the rest of your life, yeah, that's true. However, it is in no way easy. It is simple, but it's not easy at all. So it's far from automatic to begin with. It takes an enormous amount of effort, and return in the beginnings are very, very slim. So you need to do a lot of research, and once you're pretty much sure that that company will perform, you're not even guaranteed that that company will perform. And when I say that the returns in the beginning are very slim, then, take my example. I received dividends of 20p, £1.24, 83 pence. So how would you react when you see that sort of paycheck coming in? You probably laugh, but you know that you're not going to be living off of that 84p every month for now, but that 84p will then turn into £1.24 to £7.47 to £15.38 over 10, 15, 20 years. Random numbers I've checked there, but it's more the concept I'm trying to convey. Then, how far can you take it? So for this, I've then gone back to the compound interest calculator you would have seen in my previous videos. And let's say that you are 25 years of age and you want to start investing for dividends for the long term, so that by the time you're 50, you want to be financially free. Now, interest rate, for argument's sake, let's put 10%, could be quite ambitious, but the way I'm thinking of this is a 7% return from capital appreciation plus a 3% dividend yield. And that's both, so both of these sides are within average, so there's nothing too ambitious about this if you think about it. So calculation period, 25 plus 25 makes 50. Compound interest, compound interval monthly, and you committed £500 to it. Obviously, inflation after 25 years will be relevant, so let's include an inflation rate of 2%, and let's calculate. So at the end of the period, you will have this amount here. Now, in order to understand what you could do with this, let's now go back and include that amount here as the principal. And let's say you want to retire, so at the end of the 51st year of life, if that makes sense. Sorry, interest rate. Well, let's then assume that your dividends will then keep yielding you a 4% per year. Calculation period 1 year, and let's say that you stop contributing. What would you have at the end of the first year of retirement? You have nearly £35,000, which is way above average, at least in the UK. But this is where it gets interesting. Let's think about the fact that your partner does the exact same thing. from 35, you're now automatically onto 70k household income, which is way above average for the majority of people within the UK. And that just precludes the fact that you don't even have to touch this. So whether that yields you a 4% of dividends and a 5% of capital appreciation, you don't even have to touch the 5%. So all you're doing is withdrawing the interest you earn through the form of dividends, and at that point you then can move country, you can travel the world, you can dedicate more time to your family, see your grandchildren, and so forth. So all in all, I hope you've taken some good value from this video. It is crazy to realize how much time can change our lives if we take action now. And yeah, thank you very much for watching this video, and until the next one, cheers.